I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens, enabling an enterprise view of exposure. Today's guest is running a global reinsurer with bold ambitions to double in size over the next 5 years. Nick Hankin is Managing Director of QBE Re. Now into his fourth decade in the industry, Nick has market experience in abundance. So when, despite the recent relatively rapid softening of the reinsurance market at the most recent renewals, he says he still sees plenty of opportunity for profitable growth, we should sit up and take notice. This is a podcast full of purpose and positivity. Nick has a clear plan that he wants to execute and makes a convincing case that his ambitions are eminently achievable. On the way, we cover all the major issues of the day, including the insurance and reinsurance opportunities arising from the data centre boom, the best use cases for AI, as well as the emergence of AI as a new casualty peril in its own right. Nick is good company and a great communicator with a clear vision. The next half hour will fly by. Enjoy the podcast. Nick, welcome to the Voice of Insurance.
Hello, Mark. It's great to be here talking to you today.
Anyone out there who doesn't know you, can you just briefly introduce yourself, run us through your career, and why don't you start with how you got into insurance and reinsurance?
Yeah, well, this is the 31st year that I've been in insurance and reinsurance, Mark. So I started as a graduate trainee at Royal Sun Alliance.
So this is where everyone starts?
Yeah, a number of different insurers, AXA, Zurich, AIG, Aviva, and I joined QBE in 2020. So I joined in a group role. I then moved into the international division as a chief underwriting officer. And that included being the chief underwriting officer for our reinsurance business, QBE Re. I've done quite a lot of work, I guess, across the industry. So I've worked with Paul Re. I was the chair of ClimateWise for a period. And I'm also currently the commercial chair of the ABI Commercial Committee.
ClimateWise, that's a UK industry initiative, wasn't it? It was from about 15 years ago?
Yeah, for about 15 years
ago. But it's still going,
ago.
yeah?
Still going, yeah, to basically help manage the transition to a lower carbon economy.
So you're right up to date. Why don't you give us a bit of a sense of scale? Because QB is such a big business. And it's not always easy to break out the reinsurance because there are different divisions, but there's not a specific reinsurance division. Can you give anyone listening a sense of the scale of QBE Re as an entity if it were a standalone entity?
Yeah, absolutely. So I was very fortunate to become the managing director of QBE Re on January the 1st. QBE Re is our global reinsurance business. So it's a business that's tripled in size in the last 6 years. It's now $3 billion. It has a truly global footprint. We have a team of around 150. But we're obviously part of the international division, part of QBE. So we've got a massive amount of internal advocacy and support in terms of driving the growth of that business.
And where would you say that you're headquartered?
Well, we've got a London base, but we're also in Bermuda, we're in Brussels, we're in Dublin, we're in Dubai, and North America. So we've got a truly global business there working with a lot of our global clients. We have 3 global products, so property, casualty, and specialty, and we run those through 3 P&Ls. Europe and growth markets, North America, and our international P&L.
You're relatively new in this position. Should we expect to see any change of emphasis between you and your predecessors?
Well, I think their strategy is really clear, Mark. So we want to double the business in the next 5 years, so take us to around $6 billion business. We continue to recruit and develop the team and the capabilities to do that. The priority for me, I think, really is around continuity. It's about stability. It's really about partnership with our clients, building on that expertise, responsiveness. I'm very focused on underwriting expertise and skill and that accountability, but also that ability to make decisions close to the market, close to the clients. So there's a lot of continuity, and that's really what our clients and our partners tell us that they value in QBE Re. And I also want to make sure that we continue to focus on investing in the business. So modernizing it, the technology and the tools to help our underwriting teams particularly make those decisions.
What's the driver of that ambition? Obviously, no one ever does anything just because or just for the sake of it. Is it because, do you feel that scale is required?
Well, I think we have scale.
Yeah.
But I think what's exciting is we've just got the chance to be a truly relevant global business to our clients. So kind of probably about 70% of our clients are in that global key client range. So sophisticated buyers of reinsurance looking for multi-year partnerships, also looking for a partner who's able to assemble different products, different treaties across different jurisdictions and different products, and take a holistic view in terms of the way that we can actually work together and support them in developing their business.
Yeah.
So I think QBE probably came from a relatively small base 5 or 6 years ago. It's now a really relevant reinsurer. We think we can double the business to $6 billion. We could probably become a top 15 reinsurer. And I think that makes us a really meaningful part of QBE as a group. It also makes us really meaningful to our clients.
So you want to be sort of on that team sheet when, those reinsurance managers, those boards from cedents are thinking about their reinsurance. You want them to think, right, well, yes, QBE needs to be part of this because they're here. They're going to be here and they're going to support us. And they're the sort of people that we want to stay reinsured with.
Yeah, it's a long-term view. It's consistency, it's predictability. And it's also, we want to have that curiosity where we really understand those organizations. We understand where they're growing. We understand where they're looking to do in terms of developing their portfolio and their reinsurance solutions, and then be part of that for the long term.
So is it relatively high service model in that sense? Because you need to spend that time with the client, that the client knows that you know them. And actually, when I was listening back to the last podcast with Chris Kaluri, your predecessor, as part of that strategy was very much, our stated aim is to be a real partner type reinsurer. We're looking for a deeper, broader relationship with the right cedents. And then obviously as they grow, we'll grow, and they'll grow profitably. Therefore, we'll grow profitably. We'll value them. They'll value us. And we will have that kind of partnership. And is that still very much the strategy? Do you think a lot of that growth is going to come from the fact that you have these good partnerships? You're just going to make them better partnerships, broader partnerships, that perhaps if they were single class, you can make them broader, cross-class, whole account or whatever. And then you get the growth that way without having to go and find thousands of new clients.
Yeah, I think that's certainly an element of it. I mean, I think we want to have a number of different areas that we can pursue to drive growth. So you would look at new products, you look at different jurisdictions, look at adjacencies to what we already do well today. But I think to pick up your point around those global clients, I think if you just look at the economics, we believe those clients will be very successful organizations in the future. So in the next 3, 5, 10 years. So we expect them to grow. We therefore then also see an opportunity for us to maintain and grow our share of the reinsurance participation with them. And so if you put those two things together, we will end up with a materially bigger business in that timeframe.
And I suppose, yes, if you go from 3 to 6, it's not as if you're straining the market, because you could be given a bigger share on every treaty that you write effectively today without it worrying those security committees, for example.
I think that's absolutely true. I mean, we've got a very strong balance sheet and capital strength, which again, our clients value. But to pick up your point around the client understanding, the way that our model has been designed is to have, I think, a very healthy leadership conversation between people who've got responsibility for global products, people who've got responsibility for regional P&Ls, but also then leaders who are looking at just from a client perspective and a partner perspective. And then we've got a strong capability on pricing, portfolio management, analytics, developing those tools for the underwriter. So I think bringing all of that together creates a truly global business. And one of the things that I'm doing, which I think is building on a lot of philosophy that Chris put in place, is to create that one team ethos.
Yeah.
So for that to really to be of value to our clients, we need people to be able to make decisions that in isolation, they may say, well, they're marginal, but that when they look at it from a client perspective, I think actually it makes a lot of sense and shows up in value both for the client and for QBE.
And also you mentioned about adjacent, adding more capabilities into different lines and those kind of understandings. So is that generally the philosophy, again, to be doing all the things that if your cedents, your preferred cedents and those preferred clients are in a particular class, then presumably you want to be in that class. If you're not, you want to add that capability so that you can broaden that relationship so that, if they're in this line and you're not currently in this line, you think, well, this would be a very good thing to add. I suppose the other way of describing it, that do you become more of a generalist? And I want to qualify that because generalist might sound like you're not very good at anything because you just do a bit of everything. But of course, that's not the case, i.e. generalist in the sense that you have a specialism in pretty much every specialism that there is. And you add them all together, it means you do everything.
Yeah, I think I start from the point of view that you need really amazing capabilities to do
insurance
or reinsurance.
Whatever line it is.
So if you're going to add credit or you're going to add mortgage or you're going to add structured reinsurance, then we basically look to build fantastic expertise. And if we've got that, or we hire that to complement what we've already got in property, casualty and specialty. But I think you don't have to do everything for every client. So again, those organizations are large enough that if you've got a really fantastic relationship, you can have a very transparent conversation around what they're looking for, what your appetite is, what you can do and participate. But the key thing is not to provide surprises. So the key thing is that kind of year in, year out consistency. We're not changing, we're financially strong, we're with you for the long term, and just finding solutions that work for both parties.
I suppose things like your cat appetite changing from one season to the next, it can be very painful when they have that expectation. Well, I thought I kind of counted on your 15% and it turns out I don't have that anymore, or that's now suddenly become 5 and I'm in a bit of a pickle.
Yeah, and I think it's having the empathy for the person on the other side of the desk, isn't it, for the reinsurance buyer? And I've done that role, so I understand that those teams are looking to provide solutions for their business CEOs and MDs who are all trying to grow it.
You're letting them down, aren't you, in front of their own board? That's not what you want to do.
Yeah, absolutely. So it's really important to me.
Obviously, talking about surprises, I talked to some people on the reinsurance side of the desk after the 1/1 renewals, now after 1/4 renewals. Some have expressed a certain amount of surprise that the market softened as fast as it did. Some described it as say, hey, we've got 2 years of softening in one. I was surprised. I'll go every year to Monte Carlo. We must meet up at Monte Carlo if you're there. And I do a documentary style podcast where I talk to lots and lots of people. I talk to slightly too many people, actually, but I do a massive canvas of the market. And of course, every reinsurer last year, 2025, Monte Carlo was saying, yeah, we've done really well. We'd like to do a bit more. We've got more capital. We've got our appetites kind of back. Our mojo's back. We're all here. And rate adequacy is here. And now, obviously, you have a surprise. People like surprises when they're good surprises. And in the financial world, we absolutely know that no one likes negative surprises. So we've had this negative surprise. Does that affect your appetite in any way? Does it make you more cautious? Or are you still looking at them thinking, the adequacy is still there and we need to press forward? And of course, you still want to grow. Presumably, you grow knowing what you're growing into.
I think your last couple of sentences absolutely mirror my sentiment, really, in that we anticipated a lot of that softening market.
Yeah, it could not happen, could it? I mean, we've all done a bit of economics.
We've run economics, and so we anticipate that when we set the plans. We've anticipated that as also when we've set the trajectory for the growth of the business. I'm still really ambitious for the business. I'm still really ambitious for the growth opportunities, but it's supported by a really clear focus on underwriting discipline and the right tools and understanding the economics of each particular deal and each particular arrangement. So the imperative to earn a decent return on the capital that we're provided doesn't go away. That's a really important deliverable that I and the QBE business need to deliver. But the strategy is really unchanged. What I was talking about in terms of those global and key clients, I think are the clients that we believe are best positioned to succeed through a cycle. They have the most diversified portfolios, and the softening is not equal in every single product line, and the softening is not equal in every bit of the jurisdiction. So I think the trick for us and the test really of any kind of strategy or any successful business is, can you be successful in different market conditions? And we're still very confident on that growth trajectory that I outlined at the start of our conversation.
Yeah, and I suppose in the grand scheme of things, yes, it's not market destabilizing, is it, necessarily, particularly over that sort of period. Again, it's not impossible to do.
It's not impossible to do. And again, the important thing is about making sure that it's a really sustainable market. So I think what both parties want is that the pricing is adequate, the terms and conditions make sense, and that actually those products and services are going to be there for customers year in, year out. So I think there's a mutual interest to have an orderly, but it's still a highly competitive market, as it should be. There's a lot of appetite.
You're still happy generally with the rate adequacy?
Yeah, we're still happy with the rate adequacy.
And also on the T&Cs, terms and conditions are not eroding. Obviously, we know this period of excellent profitability we've had in the reinsurance market has been not wholly, but say the fundamental shift was to increase the retention levels of cedents worldwide. Obviously increase the price of the product ultimately, but at the same time, certainly decrease the share that reinsurers were taking of those attritional losses, which obviously are hitting all of us. It's not as if they've gone away. We look at the aggregate numbers that come out every year, over 100 billion every year, and it doesn't seem like it's ever going to go down from there. That's our base level now, isn't it? So they're not being eroded, would you say?
No, they're not. And I think there's a lot of value of both parties to having the right attachment levels. And I think moving the market away from being just too transactional, I just don't think that is a particularly good place for everyone to be in.
Yeah, and the right sort of buyers know exactly what they're buying. They're buying the bigger stuff and the really volatile stuff. That's what they're paying to take away. That's what your job is. And if they're bothering you with small things all the time, again, their deductible's too low, isn't it? And I suppose they would understand that you're supposed to be saving up for a really rainy day. If every time there's a little bit of drizzle, they come to you, it doesn't seem to make much sense. I would think of that from a buyer's perspective.
I think that's absolutely the case. And again, I think particularly those global and key clients really understand that dynamic.
Another thing that's been a big feature of the last few years has been the way that the ILS market, the alternative capital market, has really held up. It's now growing. It's hitting record levels. You've been engaging. First of all, you've got a casualty sidecar. Really interesting to hear about that, obviously, because QBE, certainly on the insurance and reinsurance side, always been known as a casualty market within the market, particularly in the London market and international casualty space, always. So run us through that.
I think, Mark, that strategically, a big focus of us is really about portfolio mix and portfolio optimization. So I'm having to think about what's the right mix for QBE between property, casualty, specialty, any other particular portfolio we put into the mix. How's that fit with the international mix? How's it fit with the target mix for QBE. So one of the opportunities I think we saw with the sidecar was allowing third-party investors to participate in a defined portion, particularly of our casualty portfolio. So it's a quota share arrangement. It gives us additional capacity. What it enables us to do is really provide positive outcomes for our clients. So I want us to be in a position where we can say yes to clients if they need more support on casualty or if they're growing a particular line, even if it's potentially meaning we're a bit overweight on a particular product at a particular time. So that's very important as a tool for us to balance the portfolio mix, give stability. I think it's another really good evidence point of the confidence that people have in the quality of our portfolio. And we did it as a first one for the 2025 underwriting year. It's certainly something that we would look to do to pursue in the future and build those long-term relationships with some of those investors.
Also cat bond, but I suppose you've been in that market for perhaps a bit longer.
Well, we have also looked at cat bonds. Yeah, I think again, there's an opportunity there potentially.
But in terms of the last time that we had the ILS market really humming along and very confident and full of capital, hitting record issuance and record outstandings, let's say around 2013, 2014, it was a time when perhaps the traditional reinsurance market was looking upon it perhaps more of a threat and thinking, wow, this is actually a different source of capital that has a different cost of capital, has a different return hurdle from us. And this is slightly destabilizing. But also, if there is cheaper capital out there, then it would be silly of us not to engage with it and put some of it in our pocket and lower our own cost of capital by using it. What's your view on that? And for one, it's not 10 years ago, it's not 12 years ago. That capital, we'd all have to argue that we get more sophisticated all the time because we're learning our lessons all the time. There are new lessons to learn, of course, and the world changes, but we do hopefully get better at solving yesterday's problems than we were. So for one, we don't view a burgeoning ILS market as being something that might destabilize the market. And also engaging with that is, again, an interesting strategy. It's difficult to know. Certainly, I would say the ILS market 12 years ago, there was sort of markets that some people would say were potentially naive. These days, one would presume that they've all learnt their lessons or that they are more sophisticated than they used to be.
Yeah, I would say that we have to think about looking at all these different avenues to help us support our clients through different market conditions. So if we come back to our earlier conversation, what we don't want to do is just in a softening cycle, just have to withdraw capacity and withdraw products and services and just say, well, it doesn't meet our hurdle rate, so we just cannot support you. And so we have to look at the retro market. We have to look at sidecars and third-party capital to help us manage our net exposure and manage our profitability and performance through a cycle. So I think we had a good result. We're very pleased with the result that we had with the casualty sidecar, and we are working with those partners. Again, similar to the way we think of our clients, make it sustainable and a good outcome for them in the long term.
Let's say your own seed more, you seed more. Does it just make more sense? You reduce your own volatility.
I think it's partly that as you're looking to grow, although we've got really clear plans about where we think that growth will come from, whether it's from a customer type, whether it's product type, or whether it's from a part of a certain region, as you are executing plans, inevitably different opportunities present themselves. And so sometimes that changes your portfolio profile or your volatility profile or your capital profile. And you just need to have as many tools and techniques as you can to manage that so that you can make quick decisions and capitalize on opportunities that present you. And that way, I think for us, Mark, it's very important to have the internal advocacy within QBE. So the fact that Chris Galuri has now become our Group Chief Financial Officer, the fact we've got so much support from the Group Exec and from the International Executive Board means that we've got the right capabilities internally to help us manage our portfolio mix and our volatility and the capital requirements to grow the business.
I suppose if you just boil it down to the fundamentals of underwriting, you want to say yes to all the good stuff. So if you've got some very good stuff being offered to you, you want to say yes. Sometimes you need the tools behind you to be able to allow you to say yes with great conviction and put that line down.
Yeah, we have a very simple business model. We effectively have a very good understanding of our client mix. We have a really clear view on which products we want to be in on a global basis. And we have these 3 regional P&L. So all of those have slightly different characteristics and slightly different requirements. And our job is to knit all of that together for a successful outcome for the clients and to deliver the business. And it's really important to me, Mark, that the business delivers the overall top and bottom line result. Yeah. So one of the things that I reinforce all the time with my team is that even in our most successful years, we will have parts of the portfolio that underperform, some products that underperform, some geographies that underperform, but ultimately we have to be accountable to deliver that overall outcome and deliver the growth potential that's beyond us. So all of those tools, techniques are just things to help us manage our way through that overall objective.
Yeah, I suppose when you hit 6 billion, I presume when you look at the theoretical composition of that 6 billion, it theoretically should be a less volatile proposition than the 3 billion today, one presumes, because it should be more diversified, more balanced.
I agree with that. And also remember, we're part of the international division. So the international division is an $11 billion division, of which QBE is $3 billion. So again, we run that as a single business unit effectively. So we get some diversification benefit there as well.
And in terms of this market, what's your feeling at the moment about where it's heading? So the softening seems to be continuing. How far does it have to go before you start to feel that you need to walk away, or at least lighten the load a little bit and not increase lines or start reducing line sizes, for example?
Yeah, so strategy is really long-term and it's around partnership. We look at portfolio performance, we look at incentives. We do really have a focus on if we have underperformance. And as I said, we want to make sure that we're meeting or exceeding our cost of capital. But I think we've got the ability to have so much diversification against product and client and geography that we can actually manage it quite comfortably in the market conditions that we're trading in currently.
Where are things good at the moment in terms of where the growth is coming from? You've got this worldwide purview. Where are you most happy, the opportunities that you're seeing in terms of pure growth?
I probably categorize them as, for us, it's potentially some new product areas. So credit, mortgage, we also have a life reinsurance business. I see growth in all of those areas. Within our specialty portfolio, I think we've still got some growth areas in areas like A&H. We're seeing more inquiries and opportunities on structured reinsurance, with areas like whole account quota shares, particularly in North America. I think for our business, we were historically underweight in North America. We've certainly grown that business more significantly. We're now over $1 billion in QBE in North America. But again, we've still got some growth potential there. Geographically, we also can grow more in Asia. So we've just recently opened an operation in Singapore. Again, we think there'll be further opportunity in Asia, supporting and tying in with our insurance operation. QBE has been in Asia for a long time. And then finally, again, we come back to that client strategy. And we've made really good progress in being relevant for those top clients, those global clients, the top 10, 12 clients. But we think there'll be a lot of organic growth with them over the next 5 years.
From a more generic question to a really specific one, there's been a lot of excitement the last 6 months, particularly when it's really sort of hit everyone's front pages. The data center boom, there's a huge amount of investments going in. It looks like one of these situations where the whole market has to come together, where we're going to require all the capacity of everybody to agree, or most of it, as an opportunity. We're talking about very large facilities, huge amount of investment, starting with construction. Are you starting to see some of that demand come through? And is this sort of thing you're penciling in thinking, well, how do you view it as an opportunity? Because obviously no opportunity comes without it being a problem to be solved. So obviously some of these facilities are so enormous that they're bigger than most individual cedents.
Yeah, they're a long way from the old office risks that are used to insure. I suppose they're a good example of why there's so much growth potential in the reinsurance market as the investment in these sort of capabilities grows exponentially, and the solutions need really good collaboration between the broking market, the insurance market, and the reinsurance market to provide enough capacity and enough reinsurance support to provide some solutions. So yeah, we're doing a lot of work currently within QBE in terms of the way that we join up the proposition for data centers and join up the thinking between the insurance business and the reinsurance business to come back with solutions for clients.
So it's something that you're starting to actually see some of these things coming across the desk, and they've got reasonably big numbers attached to them.
They haven't, and we've thought about the way that we organise ourselves in QBE to best respond to those, as I think as a number of different brokers have also thought about that.
I always think, yes, the thing about technology, of course, is that you would have needed one of these data centers the size of multiple football pitches or whatever. Of course, now that would fit into your telephone. And yeah, I always wonder, will the tech evolve so fast that you can shrink the size of those data centers down to, a small box? I presume the opportunity won't be around forever, but it's around today.
Yeah, and I think it's also about where's the risk sharing between the investors and the owners of those data centers and the insurance and reinsurance market, because I think that will find its equilibrium over time.
Obviously, what's driving these data centers is the boom in AI.
Yeah.
Well, I've been talking about AI on the podcast for at least 2 years now. And I suppose the line of question has to move on from sort of, hey, what are you experimenting with, to sort of, what have you experimented with and what's worked? Where have you found that it's the most useful, and where you're really keen to be fully implementing something and really pushing the accelerator on it and saying, right, I know this works and I'm really happy to start implementing this, obviously with all the right guardrails and everything else and controls. But where are you kind of thinking, right, within the reinsurance business as a reinsurer, where does AI make the most sense to be fully implemented?
Yeah, I think for us, it's a real great enabler for pace, efficiency, and helping our teams just do more. If you think about that global business at 3 billion, going to grow to 6 billion, it's still quite a small team. And it's also got a team with fantastic expertise that we want to be focused on the most impactful pieces of work. So either internally or particularly out with clients and building those relationships. So I think for me, we're looking at how do we use AI to give us better insights into the sort of services that we need to provide our clients. I think we are starting to use AI to process unstructured data, so to help us with some of the underwriting assessment. And we're giving our team more self-service tools. So things around MI, the way they can actually interact with their portfolio and their underwriting process. We're using that to help them deliver that. But what we've done on AI as part of our modernization program is everything's linked back to the objectives and the key results of the business. So everything is linked back to what are we actually trying to do in terms of delivering the growth or delivering a better experience for our people or just delivering a better way of actually understanding the data that's coming through from our seed partners. But particularly that ability to use AI to fully link up everything that we're doing for clients. We're very disciplined in the way that we think about every client engagement and the notes that we write following those meetings. And then actually just having AI as an ability to join that up just gives a global team the ability to actually keep on top of everything that's going on and what we're supporting a client.
So is it more about productivity? I'm sure, everyone in senior management would love to get to that 6 billion target and keep the same number of employees and just double the turnover and profit per head would be wonderful. I mean, you're bound to have to hire a few more people to get there. But is it really more about productivity versus improving underwriting skill at this stage?
I think it's probably a bit of both. So I would absolutely expect to grow the size of the team as we double the business. But those hires are really around targeted expertise and capability. So we think a lot of that AI will be able to do a lot of that kind of operational support, which is important from a productivity point of view. But I actually think the bigger win for us or big opportunity will be about insights and tools and just accelerating the way that we think about the sort of portfolio composition and different solutions. So actually very additive to the underwriting decision-making process and additive to the portfolio process.
I suppose it has to come in the right order, doesn't it? Obviously, you want to move all the employees sort of higher up the food chain into greater value-added tasks, and you don't really want to pay people, to be manually re-entering and reformatting things and just trying to get their head around what this submission is and put it in a way that you can understand it and start to analyze it. I suppose once that's being done, of course, then you can start to use the AI to do the clever stuff, but you need to get the AI to get the house in order in the first place so you can then do the next stage. I suppose it does come in a logical order, and I suppose it's perfectly understandable that you've got to get the first bit right. Otherwise, the second bit won't work because you'd be using the wrong data or you're comparing apples with oranges and all the other things that you might do.
Yeah, I think you've always got to conform your data and you've got to have those sort of underlying systems. We're ensuring that we have the same common technology platform across the whole of QBE globally. That will make a really big difference. So I think it's a combination of both. There's lots you can push forward on that's more innovative at the same time you're doing the foundational work, but I think your characterization is correct.
Yeah, and I suppose it'd be very nice to log on and look at something, and then the AI might say, do you know, actually somebody in North America has written something really similar to this, and here's some of the working they did at that point. Do you want to have a look at it? Because it might give you an interesting flavor of how to look at this new risk you've just been shown over here. And there's so many really great things that you could do.
I think that's the key win for us, because if you'd probably gone back to that business I described that had tripled in 6 years ago, it would have been quite siloed by product or by geography. We're now a truly global business. And so a lot of that join up is being done through technology, but it's also being done through leadership and people making sure they're sharing and on calls. And I think the AI will just help us to consolidate all those insights, whether on a product insight, underwriting insight, claims insight, or a client insight, and then give people the access to do that to help them be more impactful with their clients.
No, it's really good, isn't it? Because you can't go back to the old days when not everybody knew what everyone else was doing. And I have experience of that when I was a broker, odd, anomalous situations of global reinsurer with a Norwegian office ended up doing Spanish business to me when their local office had already declined it 3 times. Weird things. One would hope that will never happen again. What about AI? Now, putting your casualty reinsurer hat on, how do you view AI as a risk in itself, as a new E&O, an emerging tech E&O risk? And, well, we don't quite know what other type of risk it might be, but it's obviously a tech E&O risk if it goes off and sort of, whatever Mickey Mouse did in Fantasia in the Sorcerer's Apprentice, he made his broom go and collect the water for him, but then they all multiplied and then it all got terribly out of control. And luckily the sorcerer woke up from his nap and everything was okay. But we know that AI has that capability, that sort of systemic capability to get things wrong. What's your view from a casualty perspective, from a casualty reinsurance perspective? Obviously, there are a lot of people out there now in the startup, insurtech type world are looking to be the first insurers of AI. Partly, sometimes it's almost like an enterprise risk of almost the efficacy of that AI as well, which is something that's generally a red flag for insurers to say, well, we don't usually want to tread there. But again, this is a new world. Why not? What's your view on it anyway? And do you think it might end up being a standalone class?
Yeah, well, I think it's certainly, as of today, it's a risk amplifier, if only because of the scale.
It will make the error worse.
The scale, the speed, I guess, of the technological change, the fact that it could drive correlated losses or systemic risk. It's going to be quite challenging in terms of attribution, in terms of causation. We probably don't think of it at the moment as like to be a standalone line. So probably embedded, similar to the way that cyber used to be thought about. And I think over time, as it matures, we may end up with clearer definitions, even potentially exclusionary language coming out. But at the moment, I say we don't see it as being a standalone class.
We're not there yet. I suppose if a load of losses suddenly started manifesting themselves and we could see what a new problem that we hadn't the most likely thing with AI, like with everything, is we know that there's going to be unforeseeable things that happen. We know enough, but we just can't foresee them, can we? So if we could exclude them now. But what's happened with cyber is you end up with, there was particular things around cyber war and property damage, specifically related language. At the moment, obviously, this is a silently included coverage in all liability insurance. It's not because it's not excluded.
It has similar dynamics, doesn't it? A cyber, which was silent and then more affirmative covers and then separate products. And it went on that evolution. I feel it's a little bit early to say whether AI will follow that same pattern. But at the moment, we would just see it as an amplifier to the existing products.
We're already probably all using AI so much already that it becomes an impossibility to exclude. You just have to say, well, this is just the world now. I was thinking about an example saying, well, you can't really exclude telephones from liability. And it's just everyone uses a telephone.
It just becomes another risk characteristic, another thing you have to assess, another thing you have to price, another thing you have to manage from an exposure perspective.
And you need to understand and you want to know what sort of AI they're using, what they're using it for, and how they're using where the guardrails are. I suppose, the other questions in the proposal form, but probably it won't be a form. It's going to be, in your online interrogation of these risks, I suppose, new data that you'll learn. These are the new data points you're going to want to know.
There'll be new data. You'll be looking at the way how organizations are thinking of it from a risk management perspective. You're looking at whether there's different exposures by different trade sectors. I think all of those things will evolve and mature along with the technology.
But you're not necessarily losing any sleep right now.
Not at the moment.
Well, Nick, I've really enjoyed talking to you. Good luck on your journey. So I think that obviously means we have to book in a time, certainly in a year or a year and a half or 2 years' time, sort of check in on how you're getting on, how the market is then and how QBE Re is within that. Until then, thanks so much for talking to me and I've really enjoyed chatting to you.
Thank you, Mark. Really appreciate the opportunity.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.